Jenny, always great to have you on CNBC. I mean, it's the question everybody's asking. Why the heck is the stock market holding up as well as it is? And I know it's still down year to date when we're probably going to have 30 million people unemployed in the United States after this morning.
Right. This is something I've seen my clients and everyone I talk to really struggle with, which is the concept of, we know it's bad out there. I'm sitting in New Canaan, Connecticut right now, and as I look up Main Street or Elm Street just up this way, everything's closed. So if everything's closed and businesses are struggling, why is the S&P only down about 11%, 12% right now? I think the S&P, which we've historically relied on as a reflection of U.S. business, is not reflecting U.S. business right now. And I think that we need to remember that the S&P right now has 4 companies, Microsoft, Apple, Amazon, and Google, that make up nearly 20% of that index. That's not reflective of what I see here. That's not reflective of what most business is. So I'm looking at things like the Russell 2000, which is down about 24% on the year, as probably more reflective of what we see broadly out there. I also think it's important to remember that if you're thinking to yourself, I'm scared, I don't want to invest in the market, you know, it's rallied, it's a disconnect, you don't have to just buy the S&P 500. You can buy individual companies, you can buy other indexes. There's still a lot to do.
Yeah, Russell 2000 is more Chang's Table or Tequila Mockingbird on Main Street, if you will, than the S&P 500,
wow.
which is big. Yeah, you got the reference there up there in Connecticut, Jenny. I'm thinking about you guys. So where are those opportunities? What specific companies? Listen, you're supposed to buy low. You're supposed to buy when others are fearful. It's hard, and a lot of people are out of work. But these are the times that guys like Warren Buffett have made their fortune. What looks inexpensive to you, Jenny?
Well, I'll tell you what I added to in my portfolio this week. I added to 2 companies that are both smaller cap, that are both under the radar, that have both announced earnings and have had terrific numbers. So I added to Compass Diversified Trust and I added to Hercules Technology. These are both essentially private equity plays, but in a publicly traded market. And they have tremendous cash flow. They've been able to sustain their dividends. The dividends are like 9 and 12% on them. And they're just fine, and they're under the radar. But they also, because they were in a small cap index, which wasn't the S&P, they've been really depressed in terms of share price. So you can buy things like that. Last night, CenturyLink reported. CenturyLink has about a 10% dividend yield, trades at 9 times earnings, had quite strong revenues. You can buy companies like these. There's a lot to do out there. You can also buy larger cap if you want to. For example, AbbVie, which makes Humira. That's much larger cap. They're acquiring Allergan, but it also trades at less than 10 times earnings and has a nearly 6% dividend yield. So there's stuff to do. It's not just, oh, the market ran away. Oh, the market's a poor reflection.
Yeah, and that's why, listen, with all due respect to the numbers and sort of the headlines, always say, well, the markets rose. Sometimes the markets didn't rise. To your point, the huge donkeys pulling the rest of the cart. The FANG stocks, they're the ones that rose and everybody else got left behind. Do you think, like Warren Buffett again said, you want to bet long-term on America? Is it time to maybe leave behind some of those big winners you've made a lot of money on over the past decade and find different opportunities? Should we be sellers as well?
I don't know. I think it depends on what the weight in your portfolio is. So let's say you've got Amazon and it's like 10 or 12% of your portfolio because it's grown so much. You should definitely be trimming that. That's just not prudent to have that big a position. But if it's 3%, maybe you hold it. And I do this a lot. I'll see a portfolio come in and they have these legacy positions. So you can hold those. You don't need to sell them. They also don't need to go up 100% from here for you to have a nice overall return. I like what your earlier guest said earlier too about IBM. That was, that's a great play. It's safe yield, a big company transforming. So there, again, I know I keep saying it. There are things to do. There's investable areas of the market.
And what's amazing, we rarely talk about both sides of the balance sheet. We talk about, obviously, the income side, right? Oh, sales were up, profits were up, earnings were up. We forget about the liabilities. Costs are going to come down for a lot of companies. Work from home, everybody's talking about it. JP Morgan, their employees may work from home for the rest of the year. Bank of Montreal, they said 80% of their staff could now be work from home long-term, if not permanently. Companies are going to be able to save a lot of money in these times as well.
Right, not to mention the fact of gasoline prices being down so much. Like, here's a surprising one. One of the companies I own is B&G Foods, which reported a great quarter the other day. But what I think is frequently lost is this is ultimately a food distribution company. So the price of oil coming down is actually a really big deal for them. It costs them less to drive their trucks around. Even the tires on their trucks cost less, a lot, and those are based on petroleum products. So all of their costs come down. There's a lot of companies out there. And you know what? That's true. Oh, okay, that's true for us as people too. Our costs are coming down.
Yeah.